Okay, everyone, I think we can get started. So thank you all very much for joining The Current. This is Crypto Data Insights and Trends with the Kaiko research team. This is the April edition. We launched this call last month. Small disclaimer, but nothing here is investment advice. So before we get started, let's talk a bit about the schedule. It's been quite an active month. We're going to start with Riyad, our DeFi analyst. He's going to talk a bit about Ethereum's major upgrade, which happened last week, and also a bit of a DeFi update and the Arbitrum airdrop. Then we'll have Desi talk a bit about Korean crypto market structure. Connor is going to present his crypto asset liquidity ranking. And then finally, I'll talk about the Binance effect on trade volume. But before we get started, a little bit about Kaiko and who we are. Kaiko is a crypto data provider. We were founded in 2014, and today we have four main services. The first is market data. This is tick level and aggregated data sourced from 100 centralized and decentralized exchanges. The second is our BMR compliant rates and indices. This is for investable products. The third is our quantitative analytics unit. This is for proprietary quantitative models and solutions for risk. And then finally, this is research. Research is all data-driven market analysis powered by Kaiko data. So Kaiko Research, this is all 5 products that we offer. We have 2 newsletters, which some of you might have joined us from, sent on Monday and Thursday. We have a quarterly report, and then finally a weekly chart book, which is published once a week. And then you have the current. This is our monthly analyst call. You can actually already register for the next call at the same link, and you'll receive the link after the call. So finally, diving into the data, all research that you see today is powered by Kaiko. This is our centralized exchange and decentralized exchange market data. This includes everything from market depth to bid-ask spread, price slippage, and trade volume, and then a whole range of DEX and DeFi metrics, such as liquidity events, pool snapshots, and swap volume, all powered by Kaiko. So without further ado, I will now introduce Riyad to talk a little bit about the Ethereum upgrade.
Yeah, thanks, Clara. And yeah, she mentioned I'll touch on the Ethereum upgrade, DEXs, and then Arbitrum. So we can head to the first slide here. So as we can see here, price action for ETH has been much more favorable post Shapella than after the merge, up about 10% versus a decline of about 15%. And we think this is primarily for 2 reasons. The first being just sort of the general context of markets around each upgrade. When the merge happened, the ETH BTC ratio was about 0.08. So this has historically been a point of resistance for that ratio, whereas this time it was about 0.06, which is one of the lower levels for that ratio. And then on the next point, we could head to the next slide. The narrative was sort of fuzzy going in. It wasn't really clear, how the market was going to price this in. Would the large stakers withdraw and dump a lot of tokens, or would sort of the successful upgrade increase staking confidence and thus participation. And I think this has been reflected a lot in the implied volatility. As you can see, like longer durations for ETH have been significantly more, are pricing in a lot more volatility than longer durations for Bitcoin. So we can head to the next slide here. So the other important aspect here is liquid staking derivatives. So here is primarily showing Coinbase's version, which again, it just sort of makes it easier for users to access the benefits of staking without having to have the technical know-how to spin up their own validator. Here you can see that the liquidity for CBETH, which is 50-50, its volume between centralized exchanges and DEXs. The liquidity was pretty light heading into the upgrade, but actually since it's been successfully completed, it's 6x'd, specifically for the CBETH ETH pair, which sort of just suggests that there's a lot of willing buyers if CBETH's price dips relative to ETH, which is a pretty healthy sign. So we can move to the next slide now. This shows the Lido staked ETH and ETH volume. I think something that's sort of gone under the radar is how dominant Curve has been in capturing a lot of this staking derivative volume on chain. Originally their algorithm was built for stable coins, but it's turned out to work really well for these pegged assets. So staked ETH is supposed to trade 1-to-1 with ETH. And as a result, they did, 99, over 99% of volume on chain, or including centralized exchanges as well. And here you can see that there was a lot of sell pressure leading up to the upgrade. The days of the upgrade, that's April 11th, April 12th, April 13th, was about even. And since then has been actually pretty skewed towards the buy side. So I think this just sort of represents like there was a little bit of skittishness perhaps leading up to the upgrade. A decent spike in volume, but again, like there wasn't really any catalyst to like have to move out of staked ETH. And it's been encouraging to see that people are buying it post upgrade. Speaking of dexes, we can move on here. It's been a bad month for SushiSwap. Their CEO was served with a subpoena, and they suffered an exploit. And this is sort of just the like encapsulation of all their troubles that they've been having. I mean, in the past year plus, they've only registered 1 week with more volume than Uniswap V2. Obviously, V3 blows them both out of the water. So it's been a tough go. They were able to fork Uniswap V3's code, but it has so far just under like 200,000 TVL across 11 or so chains, which is not great. Finally, we can move on to Arbitrum. I think shortly after our last call, Arbitrum announced their airdrop. I think one of the unique parts of this was that they allocated tokens to DAOs. So all the DAOs mentioned here, so that's GMX, Magic, Grail, and Radiant, all received an ARB airdrop that has not been distributed yet. And you can see that after the airdrop, the newer, a little bit like flashier tokens surged, with Camelot being the big beneficiary. That's the Grail token. But for most of the tokens, the high water mark was like a day or two before the airdrop actually came out. So they've slumped a bit since, but have increased lately as ETH has shown strength again after the upgrade, and they're set to receive their airdrop soon, which should lead to like a whole new round of incentives on the network. And hopefully increase volumes and such again. And that does it for me. So now I'll hand it over to Desi, who's going to go into some interesting stuff in Korean markets.
Oh, Desi, I think you're muted.
Thanks, Riyad. So we are going to zoom a bit on the Asian markets. We know that the Asian markets have been impacted quite negatively by the collapse of Terra and FTX last year, with volumes declining a lot more than their US-based counterparts. So we can go to the first chart. There has been some catching up in volumes this year. These are the weekly trade volumes on Coinbase, the largest Korean market, Upbit, Kraken, and Gemini. And what we essentially see is that Upbit has been surpassing Coinbase in terms of weekly volumes throughout most of the year. On average, in the first quarter of the year, weekly trade volumes on Upbit are up 40% relative to the previous quarter, the fourth quarter of 2022. On Coinbase, there is basically on average no change. So a lot of catching up. what has been driving these volumes? We can go to the next chart. We looked at the share of altcoins versus Bitcoin and Ethereum on Binance, Coinbase, and the 4 big Korean markets, which are Bithumb, Core Bitcoin, One and Upbit. And what we see essentially is that altcoins have been driving the volumes on Korean markets with a market share of over 90%. This compares to Binance, where altcoins are around 60%. We see that the share of altcoins there has risen in the second half of March after they canceled their zero fee promotion, but it remains a lot lower relative to Korean exchanges. And on Coinbase, altcoins account only for 42% of trade volumes. So what have been the altcoins traded on Korean markets? And this is the next chart. We looked into the top 10 altcoins traded by volume on Korean markets and on Coinbase. We compare them to their market cap rank. What we essentially see is that on Coinbase, most of the top altcoins traded are within the top 20, with one exception, the FET-IE token, which is the 10th largest altcoin and kind of mirrors growing interest into IE tokens. On Korean markets, the largest altcoin is XRP, and there are a lot of smaller cap altcoins ranked between 6 and 374 in terms of market cap. And XRP has been the largest altcoin, mostly because Korean exchanges played an important role in the recent XRP rally. Next, we looked into the buy and sell volume of XRP. These are buy and sell volume by order size on the largest exchanges, Upbit and Bithumb. On the left, we have large orders above 200K XRP, which is around 1,000 US dollars. On the right, we have orders below 200K XRP, so we assume these are retailers. And we can see that they were mostly selling from whales and buying from retail traders, which is not, it is not unusual to see some profit taking when prices are rising, but it's an interesting divide between large and smaller traders. And I wanted to end on a positive macro note. We know that recently we had a very positive GDP data from China, so this will probably add to positive risk sentiment in Asian economies. And with this, I'm going to pass the floor to Connor. He's going to talk about the liquidity ranking.
Yeah, thanks, Desi. So yeah, anyone that dialed into our last call last month would know that we talked about Bitcoin market depth and crypto liquidity being at near like 10-month lows. Order books are extremely thin at the moment. So on my first slide, I provide a general update to that. So yeah, so this is the slide we showed in our last webinar, and we saw that liquidity reached new lows since the even lower than levels since the FTX collapse. As kind of the banking environment became a lot less friendly for crypto firms, and then they were also cut off from USD payment rails, so that really impacted the operations of market makers, made them a lot less efficient. They can't really transact 24/7 anymore, and crypto firms are struggling to send money to each other, particularly in the US. So what we've seen is that liquidity hasn't really improved since this time last month, kind of hovered around the same levels, no significant improvement at least. And I wouldn't expect any significant improvement really until that banking environment does get friendlier, or else there's maybe more regulatory clarity, because at the moment what we're seeing is those crypto firms that provide liquidity to the crypto space, they're taking basically kind of a wait and see approach. They'll be reluctant to add liquidity until there's more clarity. They don't really want to get caught in a battle between regulators and exchanges right now. So with that being said, that's having an impact on crypto asset price volatility. And so one thing that I published at the end of last year was this liquidity ranking index. Essentially, it arrives at a liquidity score for each asset in the top 30 by market cap, and compares that liquidity score to the actual market cap rank. Why is this important? It's pretty safe to say that a lot of casual investors anyway, equate market cap to liquidity. So the 7th largest token by market cap, they might equate that to being the 7th most liquid token. But what this analysis shows us is that this simply isn't the case. So this quarter, like 2 weeks ago, I updated the ranking for Q1. And essentially how I arrived at liquidity scores, I combined spreads, volume, and market depth as 3 criteria that fed into the liquidity score. And I took an average rank of the three different criteria, and that led me to a liquidity score for each asset. So in the next slide is the first 2 criteria of the liquidity score, and that's volume and market depth. So on the volume side of things, I took the average daily volume for the last week or so in March. And I've just here highlighted some of the notable kind of entries. So those volumes picked up significantly towards the end of the quarter, obviously because of Elon's messing around with Twitter, and they ranked 3rd, which helped their liquidity. We have Litecoin also ranked impressively in volumes, but just as a disclaimer, I kind of, in previous research, found potential evidence of wash trading, specifically on Bit4X, involving Litecoin and Filecoin in particular. So Bit4X claimed to lead Litecoin and Filecoin trading volumes, which was slightly suspicious as a smaller exchange in itself. But then when analyzing Kaiko's tick trade data, I found that when you look at the buys and sells, a lot of them were happening for the exact same amount within the exact same second. So there was also suspicious volume patterns as well, quite flat volumes, while other exchanges were dipping and spiking along with the market. So just to add a disclaimer in there that this isn't like a completely foolproof ranking. It's like you can't just go off volumes themselves. You need to incorporate depth and spreads as well. And then Polkadot also kind of ranked poorly. To me anyway, they were ranked 17th in volumes despite a market cap rank of 9th. And these market cap ranks exclude stable coins. So on the market depth side of things there, if you just saying market depth side of things there, Sol impressed me. They ranked 4th now compared to 9th in Q4, so they actually moved up 5 places in market depth. And then BNB underwhelmed. BNB depth ranked only 10th despite being the native token of the most liquid exchange in crypto. So that surprised me to see. So in the next chart is the 3rd and final criteria for the liquidity score that fed into it, and that is spreads. So specifically spreads on Binance, as I said, is the most liquid exchange. So 2 impressive tokens from a spread standpoint were Matic and Atom, ranking 2nd and 3rd despite having lower market cap ranks. But then on the other side of things, Solana and BNB again failed to impress again, ranking 21st despite a market cap rank of 3rd. And Sol was 16th with the market cap rank of with a market cap rank of 8th, I believe. So yeah, some significant outliers there in spreads, which fed into an overall liquidity score. On the next chart there, I combine, as I said, the average to arrive at a liquidity rank for each asset. And if what we see here is if the liquidity rank in the orange is to the left of the blue market cap rank, it means they have better liquidity than their market cap suggests, and vice versa for the right-hand side. If the liquidity rank ranks to the right-hand side of their market cap rank, they are less liquid than their market cap suggests, which can really mislead investors. So on the positive side, I highlighted some winners here. So Matic ranked 3rd in liquidity overall, compared to a market cap rank of 7th, which was quite impressive. Same for Chainlink. They ranked 8th in liquidity despite a market cap rank of 14. And then Atom and Aptos impressed as well. Aptos in particular had the largest difference between its market cap and its liquidity rank. So it is a market cap rank of 27 and a liquidity rank of 9th, which was quite impressive, largely thanks to impressive volume and spreads. So on the next chart then as well, I highlight some of the losers. So these are the ones that kind of red flags to watch out for investors that can mislead investors that are just looking at market cap and equating market cap to liquidity. And again, so I talked about it a couple of times, BNB really surprised to the downside. It has a liquidity rank of 11th compared to market cap rank of 3rd. As I said, largely down to spread and poor depth. Solana, Polkadot, and Shiba also disappointed, all ranking inside the top 10 in market cap, but outside the top 10 in liquidity. And then Leo, which is the exchange token for Bitfinex, and Toncoin, which is a kind of affiliated token to Telegram. They actually rank inside the top 20 in market cap, but well outside the top 20 in liquidity ranks, 27th and 29th respectively. So yeah, really misleading tokens from a liquidity standpoint there. So yeah, all in all, it's been hard with liquidity this thin to trust any rallying crypto prices, and then particularly asset by asset. This is a good way to kind of build a framework into assessing asset by asset liquidity, and then kind of forecasting maybe which assets are in line for increased volatility, ones that are thinly traded. So yeah, with that, I'll pass it over to Clara, who'll talk about some trends with Binance.
Great, thanks. So now I'm going to talk a bit about the Binance Effect. And essentially what the Binance Effect is Binance is the largest exchange in the world, and it has a pretty much outsized impact on all trade volume trends. So if you ever see an aggregated trade volume data point, always be a bit skeptical because you might be seeing the Binance Effect, which I'll explain a bit by looking at the data. So over the past month, since the last time we did this call, 2 major market events have happened. The first was on March 22nd. This is when Binance halted their zero-fee trading program, which affected 13 Bitcoin trading pairs. They first launched this program last July, and so there was zero-fee trading, which essentially helped Binance become increasingly dominant in the crypto market. And essentially, they gained more than 20% market share just because of this trading fee program. However, when they stopped and removed these fees on March 22nd, they actually relisted one trading pair. This was the Bitcoin TUSD pair. True USD is a stable coin that was pretty much unknown before Binance elevated the pair on March 22nd and also removed fees. So today there's only one trading pair on Binance that has 0 fees, and this is the Bitcoin TUSD pair. All other pairs now have fees. So we'll see why this is important in a second. The second market event, again, had to do with Binance. Binance was sued by the CFTC, and this essentially was a result of them allegedly having US traders using the international platform. So let's take a step back now. I'm not going to talk about Binance right this second, but let's look at quarterly Bitcoin trade volume to understand a bit about what's going on in markets today. So we have this data here since the start of 2017, and this is every quarter. It includes 5 major trading pairs that I've aggregated in this chart. And we'll notice a really interesting fact, that is that Q1 2023 had the second highest Bitcoin volume ever. And that is quite a massive feat, especially considering the major industry headwinds that the industry is currently facing. Regulatory crackdowns, the banking crisis, all of this happened, and Bitcoin still managed to hit the second highest volume ever. So what's going on? Let's now break down the pairs included in this volume metric to get a better understand of who is trading what. And we can actually see that 2 pairs stand out. That is the Bitcoin Tether pair and the Bitcoin BUSD pair. If you guys remember, back in February, Paxos was forced to halt BUSD trading. So we're actually seeing essentially the end of BUSD. This is a Binance-backed stablecoin. But we can also see that these 2 pairs, the key thing they have in common is that they were the top 2 traded pairs on Binance. So here I'm getting back to this idea of the Binance effect on trade volume. Not only that, these 2 pairs had 0 fees on Binance for about 7 months, ever since last July. So I think a better understanding of volume is when we actually look at the Bitcoin dollar trading pair. Here, I've isolated trade volume for this pair. We can see a starkly different trend. This is showing that Bitcoin dollar trade volume essentially hit its lowest level since 2020 in Q1 2023. And if we flip back to this, we can see second highest volume for global Bitcoin volume, but we're at 2-year lows for just Bitcoin dollar volume. Now, the Bitcoin dollar trading pair trades on exchanges like Coinbase, Bitstamp, and Gemini, which have had a really tough time over the past year, especially with the regulatory crackdown. But it's not that tough as to have such a divergent trend in trade volume. So that's where the Binance effect comes into play. Essentially, the vast majority of Bitcoin volume over the past year has been for 0 fee on Binance Exchange. So now let's zoom in a bit. Let's look specifically at daily Bitcoin volume only in 2023. And let's now include the previous 3 weeks ever since March 22nd. We can see a very interesting trend. Since March 22nd, which was the day that Binance halted their 0 fee Bitcoin trading program, we can see a sharp drop off in Bitcoin volume. So even though they still have one feeless trading pair, Bitcoin to USD, this was not enough to prevent a huge, almost cataclysmic drop in Bitcoin trade volume. It's nearly half of what it was before March 22nd. So let's zoom in again, this time specifically on Binance. The last few charts were for all exchanges, and we can get a better idea of how this impacted Bitcoin Tether USDT and Bitcoin BUSD, we can see that the second, it's almost from minute to minute, the second they switched on fees for these two pairs, volume plummeted. And BTC TUSD, which is now the only zero fee pair on the exchange, we can see a modest increase in volume, but ultimately volume remains far lower than what it was pre-March 22nd. So now zooming in a bit, here we have, again, the same data points, Bitcoin market share on Binance, but here I've added the 13 other Bitcoin trading pairs that list on Binance. And we can see that in just 1 month, Bitcoin TUSD came to account for 50% of all Bitcoin trade volume on Binance. This is an almost monumental market event. This is a relatively unknown stablecoin. TUSD has very little presence. It's not listed on that many exchanges, yet today it accounts for 50% of Bitcoin volume on the world's largest exchange. This is a massive amount. So not only that, let's zoom out a bit. Now let's look at stablecoin market share. This is on all centralized exchanges. We can see that TUSD in yellow now accounts for, from 1 month to the next, from essentially 0% market share to now nearly 10% market share. This is almost entirely due to just one trading pair, the Bitcoin TUSD pair on Binance, which has 0 fees. So this just shows that the Binance effect is extremely powerful. It essentially has altered stablecoin market structure from 1 month to the next. And then finally, let's zoom out again to market share of volume. Here we are looking at Binance's market share of global trade volume relative to its closest competitors, the most liquid exchanges. And we can see that on March 22nd, the moment that they shut down their zero fee program, that essentially there was a near instant drop in market share of more than 10%. Binance over the past month has not been able to recover this market share, even though they do have the Bitcoin TUSD zero fee pair. This suggests that traders are a bit hesitant to start trading this virtually unknown stablecoin. And so it will be interesting to see how Binance market share recovers, if it does, and whether traders start to use TUSD over the next few months. So that's all we have for now. And now we can jump into the Q&A session. You can ask questions. And also, if you haven't yet subscribed to Kaiko's research newsletters, I'll actually leave it open here so you guys can get a link to that. And other than that, I will now start getting the questions open. So we'll start maybe at the bottom. We have, does other also cover stablecoins? If I remember, this is from the Korean market structure. I think that yes, other did cover stablecoins, but key thing to note on BitHum, I believe they do not have stablecoin denominated trading pairs, but Desi, correct me if I'm wrong. Oh, you're muted, Desi.
I think you're right.
Okay, sounds good. Okay. So how do you reconcile what is the main driver behind recent price moves in ETH? If it's investors in the DEX DeFi space or fast money institutional investors putting significant positions in derivatives options. So I'll let Riyadh answer this.
Yeah, I think we have seen some inflows into derivatives, but nothing that suggests that that is like the prime mover of this upwards move. I think sort of as I mentioned, like the successful upgrade and allowing staked ETH to be withdrawn, I think was absolutely huge for increasing faith in ETH staking and allowing institutional investors to possibly participate. Because I think as we saw, like the CB ETH liquidity has increased a lot. It's still not anywhere near enough where if I was an institution and I had to liquidate a large position, I would take a pretty significant hit. But with stake or with withdrawals enabled, that's not really a problem.
Great. Okay. So if possible, I'm keen to understand some possible macro reasons for the start of the crypto bull run we are seeing since April 2023. I'll actually pass this one to Desi, who has a lot of macro understanding of what's going on.
Yes, well, there is an echo. I'm sorry about that. But basically, the current Bitcoin rally has been very much macro-driven, right? It started in early March with the Fed intervening to provide liquidity to banks, and it has continued since. What we can essentially say is that the market is currently pressing the peak in the Fed tightening cycle. So markets are expecting rate cuts in the second half of the year. It is yet unclear whether this will happen or not. In Asia in particular, we have China reopening, gathering some speed. There is this divergence between the US, where we have some concerns around the credit crunch, and China, where authorities are actually encouraging lending. So we will see more of that in the second half of the year. But yes, essentially, the rally will depend on macro and whether the Fed will indeed pause. Even a pause will be positive for risk assets because it means less interest rates volatility.
Yeah, I think that's a good answer. It's also interesting to see that Bitcoin's correlation with equities has really plummeted over the past month. We didn't include this, but it just shows that there's a divergence in how investors are treating different types of risk assets right now. Okay. We can try this one. What do you think of the top 10 coins with much of their volume coming from circulating trades rather than people buying them directly? And why do you pay attention to Korean exchanges or the KRW market? So maybe we can focus on the second one, specifically on KRW markets. I said I'm done answering, but Desi, do you want to answer why it's important to look at Korean market trends and what influence it has on global crypto market structure?
Yes, sorry, I have an echo. I'm not sure why. Korean markets are very interesting because we saw some strong rebound in trade volumes, some catching up. We know that the Asian exchanges have been impacted very strongly by the collapse of Terra and FTX last year. Volumes on these exchanges declined more by on average 17-80%. On Coinbase, volumes last year are down 50%, so a lot less. What is very interesting is the very particular market structure, which is more retail traders and more altcoin-driven volumes. And also for me personally, it's kind of interesting that volumes are rising, and globally we have a Bitcoin-led rally.
Cool. So here we have just a quick one. Sol has poor liquidity but high market depth. I think it was market cap. So this is market capitalization, whereas the liquidity ranking incorporates market depth.
Yeah, just on that, it does actually have like high market depth. I think it ranked like 4th in market depth. But yeah, the liquidity rank takes more than just market depth. It's kind of 3-pronged, like market depth, volumes, and spreads. So it ranked kind of average in volumes, but very poorly in spreads. So there's an equal weight applied to all three. And the poor spreads ranking brought Solana down in particular.
Okay, so why has the total coin in circulation for TUSD remained almost flat despite it becoming the most popular trading pair on Binance? So this is a really good question, and I think was best exemplified by the chart showing pre and post March 22nd trade volume for Bitcoin Tether, Bitcoin BUSD, and Bitcoin TUSD. You can see that Bitcoin TUSD increased from essentially 0 trade volume to more than 60 million an hour. But overall, this is not very high compared with pre-March 22nd. So I think what we're seeing here is more a drop in USDT and BUSD volume, which is reflected by like an increase in TUSD's market share, not necessarily by a massive increase in TUSD trade volume. Because you're right that the market cap has really not increased that much, and trade volumes for TUSD have actually not increased that much. It's more all relative to the drop in volume that we're seeing for Tether. We have now, what are some thematic trades or subsectors within crypto you are watching out for the rest of the year? I will let Connor or Riyadh answer this one.
I can check this out first. Something I've been watching for a while is like the lending and borrowing space. It just feels like it's been pretty static for a while, with Aave and Compound really dominating. Um, we're watching the adoption of their V3s pretty closely, and there's some new protocols like Morpho coming out that could sort of challenge their pole position there. The other one I've been watching for in the DeFi space is like bridge tokens, particularly just with the massive increase in L2s. It's like fully, airdrop hunting season. So people are moving around between chains more and more, and bridges are like a pretty critical piece of infrastructure. So those are really the two main DeFi ones that I'm watching out for.
Yeah, and from on my side, firstly, probably in terms of like a thematic trade, I'd be looking out for a lot of the liquid staking tokens that we talked about, a lot of the liquid derivatives on Ethereum, so like staked ETH, and then the governance tokens for those protocols like LDO for Lido and Rocket Pool. Really interesting to see what happens with them now that you can kind of withdraw freely on these protocols. There's probably going to be a lot of institutional interest in doing so, as Riyadh said. So those tokens have been kind of de-risked significantly, because what we were seeing months ago when we were doing analysis on these tokens was that they were called liquid staking derivatives, but really they weren't that liquid. It's particularly on centralized exchanges. You could barely trade them at all. And there was really low depth on those tokens, but now they've been de-risked significantly from a liquidity standpoint. So you'd expect that they should see a lot of inflows, particularly from institutions looking to add a bit more yield onto a crypto asset. And then like a subsector, I guess, like I'm pretty interested to see what happens now with derivatives and how much price discovery we'll see in the derivatives markets. A lot of the research we've done lately has shown that the derivative to spot ratio has increased. So more of the volumes are actually being placed in derivatives markets now, proportionally to spot markets, and whether or not that'll have an effect on where price discovery actually occurs. Previously, it's been on spot markets, particularly with Binance offering, as we said, zero fee trading for Bitcoin markets. They saw a lot of spot volume, and spot volumes proportionally were gathering a lot more volume than derivatives markets for the last few months. Now that's reverted, and it's nearly reverted back to a normal structure without zero fees. It'll be interesting to see then, if derivatives are kind of driving more of the markets going forward. So yeah, they'd be my two.
Cool. I'm going to do this one because it's data related. On spread calculation, is that only Binance or covered on all exchanges? In which case, is it weighted by volume traded? Connor, want to go for this one?
Sorry.
This is just on the spread in the liquidity ranking.
Yeah, it's that's just for Binance, because now this is not a foolproof method with this, particularly with spreads, but for Binance, it's the most liquid exchange. It's a good proxy for the rest of the market, and it's actually near on impossible to compare on an asset level spreads between exchanges. So if you were aggregating a spread between exchanges, some exchanges don't offer some pairs on stable coins, or they offer it, but it's very, very liquid, and that throws out the average spread per asset. If you start combining exchanges also have different fee structures for market makers and market takers and price takers. So the spreads just covers Binance to kind of get an apples to apples comparison amongst them.
Great. Here we have one more about Kaiko and market data. I can take this one. So even though it is a bear market, we're noticing increasing use cases, specifically for more crypto applications such as decentralized finance, and then any crypto company that requires price feeds more on the infrastructure side. But we are still seeing a lot of interest among institutions, specifically on the research and pre-investment analysis. And I think we had some questions in the chat. No, I think it was added. Okay, I think that is about it, unless I'm missing something. But thank you everyone for joining today. And you can already register for the next edition of The Current, which will happen in 1 month on the 3rd Tuesday of the month. And feel free to subscribe to all of our newsletters. We publish research every single week. And here is the registration page. I just sent it in the chat. Thank you all.
Thanks, everyone.
Thanks.